The PE ratio. It's the most widely used metric to determine the value of a stock. In this lesson you'll learn what the PE ratio is, how to calculate the PE ratio, what the PE ratio tells us, the limitations of the PE ratio, and how to use the PE ratio. Say you were trying to buy the cheapest can of diced tomatoes. One can is $2 and the other is $1.70. This doesn't tell the whole story though. Just looking at the price of a can of tomatoes doesn't tell you which is cheaper. The cans could be different sizes. In order to compare the price, you need to look at the price per weight, such as price per 100 grams. One can is $2 for 500 grams, and the other is $1.70 for 400 grams. You realize the first can costs 40 cents per 100 grams. The second costs 42.5 cents per 100 grams. Even though the first can costs more as a whole, it's cheaper per 100 grams. We can do the same for two stocks. Just because one stock costs $70 and the other costs $60 doesn't mean that the $60 stock is cheaper. You need to know what you're getting for that $60. One thing we can measure is earnings per share. If you spend $60 and get $6 in earnings per share, that's a ratio of 10 to 1. If you spend $70 and get $5 per share, that's a ratio of 14 to 1. That's the PE ratio. It helps us to compare apples to apples. To calculate the PE ratio, we divide the stock's share price by its earnings per share. Lee's Lemonade is a company with a share price of $100. Over the past 12 months, Lee's Lemonade had an earnings per share of $10. The PE ratio of Lee's Lemonade is 100 divided by 10, which equals 10. So what does that tell you? It tells you that investors are willing to pay $10 for $1 of Lee's Lemonade's earnings. Another way to put it is that it would take you 10 years for you to earn back your money based on the current share price and earnings per share. There's one major problem with this calculation. The PE ratio we have calculated is known as the trailing PE, because we use the trailing 12 months of earnings. The problem is the ratio is backward looking. It looks at past earnings. The market is forward looking. It tries to predict what the company will do in the future. A way we can make the PE ratio forward looking is by calculating the forward PE ratio. Instead of using the past 12 months of EPS, we use an estimate of what the EPS will be over the next 12 months. This is called the forward EPS. Let's say we estimate that Lee's Lemonade will have a forward EPS of $15 over the next 12 months. To calculate the forward PE, we divide the current share price by the forward EPS. 100 divided by 15 equals 8.33. The forward PE ratio introduces a new problem. It relies on a prediction of the future. Therefore, it can and probably will be wrong. That doesn't mean it's not useful. It still tells us how much the market is willing to pay for the company's potential earnings. Whether you're using a forward or trailing PE, the implementation of it is more or less the same. The PE ratio is what's called a relative measure of value. For it to be useful, you need to compare it to something. You can compare the PE to its long-term historical average. Lee's Lemonade is trading at a PE of 10, but we look at the past 10 years and we see it traded at an average PE of 15. The market is currently paying less for the company's earnings than what it has historically on average. This could be a sign that the company is undervalued. If we were to buy when the PE is 10 and the PE returns to its average of 15, then we would make a handsome profit. So should I just buy companies when they are trading below their average PE? I wish it were that simple. You should also compare the stock to other stocks in the industry. Say you look at some other companies that sell lemonade. You calculate their PE ratio and find that the average for the industry is 8. Lee's Lemonade is expensive compared to the industry. So Lee's Lemonade is cheap compared to its historical average, but expensive compared to the industry. This is a limitation of multiples such as the PE ratio. It does not give you insights into the other factors which influence the stock price, such as growth rate or strength of the balance sheet. Lee's Lemonade might deserve to be trading at a higher price than the industry because it is growing at a faster rate. It's like the diced tomatoes example. The first can costs 40 cents per 100 grams, and the second costs 42.5 cents per 100 grams. But maybe the second uses higher quality tomatoes. Maybe it deserves to be sold at a higher price. It's the same for stocks. If a stock is a higher quality, such as growing at a faster rate, it will deserve to be priced higher. This is why you'll see companies in fast-growing industries like tech trading at multiples in the 30s, 40s or 50s, and companies in slow-growing industries like utilities trading in the single digits or teens. A company trading at a PE below its historical average, and even below that of its peers, may not be a good buy. The stock may be trading at a low multiple because its fundamentals have deteriorated. What are these fundamentals I speak about? We've covered a few of them already in previous lessons, such as revenue growth, and profit margins. If growth is slowing or margins are contracting, this is a good reason for the PE to be down, and probably not a good time to be buying. So how do I use the PE ratio? I look for companies that are trading at low PEs, whether that be low compared to its historical average or its peers, but have no apparent reason for doing so, or the reasons are temporary problems. Look at Meta. We have a stock that traded at an average PE of 40 over the last 10 years. In 2022, it traded at a PE as low as 8.5. The market had many apparent reasons. It was spending too much on the metaverse. Apple's tracking update was going to kill Meta's ad business. Government regulations were coming down hard. But had the core business really been affected? In my opinion, it hadn't, and the market agreed. Hence we saw the PE rebound and the share price from the 80s to over 500. Let's summarize. The PE ratio is the most widely used metric to value a stock. To calculate it, we divide the share price by the earnings per share. The PE ratio tells us how much the market is paying for the company's earnings. A PE of 10 means the market is paying $10 for $1 of the company's earnings. A problem with the PE ratio is that it is backward-looking, whereas the markets are forward-looking. A solution to this is to use the forward PE ratio. A problem with the forward PE ratio is that it relies on predictions of the future. To effectively use the PE ratio, you should make comparisons, such as to the long-term average of the stock or to its industry and peers. Just because a stock is trading at a low PE does not mean that it's a good buy. It might be trading at a low PE because its fundamentals have deteriorated, such as a slowing growth rate. When I use the PE ratio, I look for stocks that are trading at low multiples but where the fundamentals are intact. I need to believe that the business model is still viable and that earnings will continue to grow. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.